Hey everybody, this is Jim at SP500chart.com. I am coming to you from just a little south of Los Angeles in Santa Ana, California, where I'm going to be here doing some work tomorrow. So that means the video is going to be late today. It will be late tomorrow. And then the weekend video will be on time. Now, before we get started, I just want to remind you that the website and this video are for educational purposes only. Nothing stated in this video or at the website is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. So that said, let's dig into this chart and see what we got going on. Well, first off, today we came down for a tag on this red line. Now look at the date on that line. You'll see that that it was updated on the 29th of September, and I don't even know that I really moved it. I may have just highlighted it or stretched it out or done something like that. And we have numerous touches on that line. It goes all the way back to actually January of 2013. And now we are exactly on that line, essentially, as of the close today. So, if you ask me, I think that's an important line. I think that line needs to hold, or we could face a reversal up here that would nullify that inverted head and shoulders thesis, which, by the way, never gave us a breakout signal. It kept coming up to that neckline, but never got over it. That's why you have to wait for a confirmed signal. And even then, they sometimes fail. It's just that failure usually takes place by an inability to break that resistance. So right now, it's looking a little iffy, to be honest with you. And let's see if the red line holds, we may be in great shape. Okay, but if the red line does not hold, then I think our next line of support would be this blue line, which we'll take a look at a little bit closer up, and possibly this extended neckline from the last inverted head and shoulders that we had that worked very well. So let's zoom in just a bit. By the way, I've got a little bit of a funky connection here at this hotel. Now, we were looking at this thesis here of this being a descending wedge, yet today we went from essentially the top of the wedge to a level underneath it. Now, does that mean that this thing is absolutely hung out to dry, it's dead meat, it cannot recover? I don't think so. Sometimes you see this, but I tell you what's got to happen. We've got to get back up into this pattern quickly. And the reason I say sometimes this happens is I have seen patterns like this develop. Then you reach a point where maybe there's some real nervousness, or maybe there's a fundamental issue in the markets or something like that, and you find yourself breaking that lower line, but still bouncing at what is the apex level of that overall pattern. Because that apex level often does provide some support. If we take a horizontal line and put it right on that apex, and again, there's a little bit of give and take here and there, you can see that we managed to stay above that level despite the rather intense, or shall I say relatively intense, selling pressure we saw today. As we mentioned yesterday, I don't want Firefox right now. As I mentioned yesterday, we were in this consolidation range right here with the idea that whichever way it breaks, either up or down, we're looking for a move at about the same height of that box. And we actually, well, I guess I could say if I extend this box down just a little bit to take uh, that low into account, that's about what we did. So, there are a couple reasons to think we could bounce here, and those are three of them. The first one is the last little consolidation range we were in, we broke down, and based upon the height of where this consolidation was noodling back and forth, we've satisfied that requirement. Second of all, we are on that red line. Third, we are also, if this wedge had any validity to it whatsoever, and I'll be frank, that's debatable. But if it did have validity to it, there is our apex, and that is often a point where we see some support kick in. So guys, since I'm in the hotel and my connection is not that wonderful, I think we're going to take a real quick look at it right here. And so if you're asking me where would we need to go for this to become bullish again, well, frankly, we got to get over this blue line. It's the same thing. But in the shorter term, I would like to see a bottom form right here and at least see us get back up into, or shall I say over, this trend line that I've highlighted right now. I think if we can do that, we've got a decent chance of coming back up to retest this resistance level. So guys, what an ugly day. You can see we bounced twice on that lower support line, and I was thinking at that point, this is working beautifully. But then we saw some pretty significant weakness. We broke through that line, but still have not broken through the red long-term support line that's been working since January of 2013. We also, as I've just mentioned, did not get underneath that wedge apex level. And then finally, if you're saying, when do we really start to worry? Well, frankly, we really start to think that the wheels may be coming off this market, I think, if we duck down under 1900. At that point, I think you've got to really consider that maybe we are now forming a more significant top, because these are some fairly long-term trend lines. They've been working very well for a long time. When those lines start to break, then you have to step back from this and frankly just take an honest look and say, hey, nothing lasts forever. So guys, I think that's about what I got for you. By the way, this is on what is the date? It's October. It's the 1st. Wow, October. So anyway, thanks for watching. Take care, and allow me now to mess up my screen just a bit as I shut down my screen capture software. Thanks for watching. Take care.